Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and here with me today is John Rowe of Legal & General Investment Management to talk about how the macro influences investment decisions. Hello.
Hello.
So, how does the macroeconomic cycle influence your investment decisions?
It's entirely a macro-driven process. So there's around 30 of us, 5 economists, 8 strategists, and then the fund managers. And it's all about where are we in the economic cycle, and then what does that mean in terms of trade ideas, and then how can we put them together to get the right kind of outcome. So it's the big driver for us.
And then with that in mind, what would you say the big macro themes that investors should be aware of or even wary of this year are?
So I think at the start of the year, the thing to be wary of was this horrible narrative that this was the year it was all going to go horribly wrong. Everyone went in terribly gloomy and in some cases overly defensive. Very crowded positions. We looked at 25 different brokers and fund managers. Most of them were negative on equity, negative on credit. Now it's seen this huge rally. And not only that, with the Fed pausing, we're now people talk about 2020, 2021 as being the next recession. And as that timing gets pushed out, investors need to be really careful. The average equity return in the 12 months before the peak is 15%. So there's this real risk of kind of overly downbeat. It's going to happen eventually. And then as it gets pushed out, you miss out on these big rallies like we've seen year to date. So that would be the first, would be very, very careful. As soon as the market buys into a consensus of this is it, you've got to be very, very careful, I think, to try and take the other side, even though it feels pretty tough at the time. You've got to really manage the behavioural biases that we all suffer from as investors if you're going to do that.
With that in mind, however, it's probably worth caveating that it may not be another 2017 where basically everything gave us positive returns. Surely, even in a year before the beginning of the end, there will be stuff that does better than others.
Yeah, absolutely. So you get these peaks and troughs and definitely an increase in volatility. So it gets spikier. We had this very low realised equity volatility in the last few years, and we would definitely expect that to pick up. I mean, from here, for example, US credit. Spreads have basically gone all the way back to start October levels nearly. So there's not a lot left to be got out of that asset class, whereas European credit or UK credit are still got a lot further that they could run. So I think we will get more peaks and troughs. I think people need to be a little bit more nimble. Definitely once people and markets buy into a positive narrative, we then need to start to go the other way. So as soon as the positions get crowded, we're just starting to see more US retail buying of equities, for example, which can be a warning sign because they tend to be quite late into buying it. So it's very much trying to lean against the consensus view, even though our natural tendency might be to have the same thoughts as everybody else.
Now, I can't have a macro specialist in the studio and not mention Brexit. How concerned are you, obviously bearing in mind that you are lucky enough to have a very broad range of investments to choose from across different asset classes and globally? Is Brexit a concern?
It's a concern for the UK population. Is it a concern for UK investment returns? We think actually the risk for UK investment returns is a soft Brexit. So if you get a soft Brexit, big rebound in the pound back towards, say, 140 against the dollar, you could see some very negative investment returns because of the overseas currency exposure. The pound has been very much the main channel for playing Brexit. We heard the other day, it's too risky, it's too uncertain. Actually, the chance of a hard Brexit is very low. Over 400 MPs have come out and said, we will not support hard Brexit. That's very hard. When there's only just over 600, very hard then to get a hard Brexit. So against that backdrop, actually the risks are skewed to a very soft Brexit, and for that reason more pound, less exposure to gilts, which again are pricing in the risk of downside. So very much we're on the be very, very careful about the soft Brexit from an investment return perspective.
John, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.